Hello and welcome everyone. We're going to talk about how to pay off $100,000 in debt using real estate investment. Before we get started, just a few housekeeping rules. You'll want to turn up your speakers so that you're able to hear the presentation. Also be in a distraction-free environment. And we're going to answer questions. Please post them in the chat box and we'll answer them after the presentation. My name is Daphne Wilson. I'm president of Bell Financial, a mortgage note investment company. I'm based in West Palm Beach, Florida. I'm also founder of Note Newbie Investment Education. So I'm a mortgage note investor, and I'm also a real estate mentor and educator. And I advocate for new real estate investors, people that are very new to investing in real estate, maybe have never invested in real estate before, other than maybe owning their own home. This is my contact information here, my email address, my website. Please follow me on Facebook and Instagram if you aren't already. I will post from time to time pertinent information regarding the mortgage note investment industry. So the strategy that we're going to talk about is using mortgage notes that are secured by residential real estate property to pay off your personal debt. I'm going to show you how a $5,000 investment can be used to pay off over $100,000 of personal debt. Now, this strategy can be used for these types of debt and other types of debt as well. Student loans, medical bills, credit card, auto loans, small business loans, and income tax debt. So traditional solutions to pay off debt generally revolves around these list of things I have here. Selling your personal items that are of value, like jewelry, etc., or automobiles, things like that, fur coats, so on and so forth. Liquidating your savings since you're not earning a large amount of interest, or your interest on your savings account is dwarfed by the interest that you're paying on debt. One solution may be to liquidate savings, pay down the debt, and then restart your savings goal. Another is to borrow money against a 401k or other type of retirement fund. Tax refunds that you may receive can be used to put towards debt. Any bonuses from your job can be used as well. Some people choose to sell their stocks and bonds in order to pay down debt. Another strategy is paying extra amount in principal to pay down the debt faster. And as a last resort, oftentimes a person may choose to file bankruptcy in order to get rid of their debt. So these are traditional solutions. Well, let's look at an alternative solution using real estate, mortgage note assets in particular. Regular, ordinary folks like you and I can buy a mortgage from the bank. And instead of the homeowner paying the bank every month, they would pay you, okay? This creates a long-term passive monthly cash flow because, as you know, mortgages paid for 15, 20, or 30 years, all right? These monthly payments that you receive from the homeowner are direct deposited into your business checking account every single month. Now, how does that work? Well, when a person buys a home, they usually take out a mortgage. When a mortgage is sold, that lender will send a letter to the homeowner letting them know that their loan has been transferred to another company, okay? And that would be you. There are different types of mortgages. You have a first mortgage and a second mortgage. Your first mortgage is your largest mortgage. That's the one that you pay when you go to the closing and you purchase your home. Okay, that's your $150,000, $200,000, $300,000 mortgage or more. Then you have a second mortgage, which could be a home equity line of credit, or it could be just a regular fixed um, or flexible rate mortgage. That could be used to maybe fix up your home, redo the kitchens and bath, put a pool in the back, things like that. All right, that's usually a smaller amount. Okay, that's a 20, 30, 40, 60, $30,000 mortgage. All right. Um, Mortgages can be either current, which means they're paid every month on time, or they can be delinquent, which means they're late several months or late several years even. Current mortgages are usually more expensive than delinquent ones, which makes sense. First mortgages are usually more expensive than second mortgages, and that's because first mortgages are for a larger amount. Delinquent second mortgages provide the greatest opportunity in terms of making money because they are the least expensive to buy. They can be purchased in the price range of as low as $2,000, some lower than that, up to $8,000 to $10,000. There are a lot of loans in that category. There are loans that are more expensive than that as well, but many can be found in that price range. So this is the strategy. Purchase a delinquent second mortgage secured by the homeowner's primary residence. Make sure that first mortgage is current. Okay, you're buying a delinquent second mortgage, but you want that first mortgage to be current and never late, because that will let you know that the homeowner is interested in staying in that property because they're keeping up with that main mortgage. Now, the reason we're going to buy delinquent seconds is because the loan balance is smaller, and that makes it more affordable to buy. Why use notes to pay bills? It's not property, it's paper. So it's going to take you less time. You don't have to manage paper like you have to manage a property. So you're going to spend about 5 hours on this asset. That's it. If you do this consistently, you would maybe spend about 5 hours a month. You can buy notes at a deep discount. So it's not only less time, but it's also less money, $2,000 to $8,000 per asset. You get your capital back up front. That's the money that you used to buy the mortgage note with. You usually get that back within 6 months in a lump sum. It helps keeps the homeowner in their home, thereby avoiding you foreclosing on their home. And it creates for you and your family a long-term passive monthly cash flow for years. How it works. So suppose you have a large outstanding loan balance. Okay, this balance is approximately 110 grand. Without question, you owe it. You're going to need to pay it back with interest, all right, over time. So here's the idea. Instead of making payments on these loans, on this debt from your own paycheck, what if you purchased a note and it paid the loan back for you? Okay, let's take a closer look and see how this works. Suppose you purchased a second mortgage note and the homeowner owes $40,000. Okay, you purchased this note, they owe you $40,000. All right. If you look at the amortization schedule on the right, and I'm going to enlarge it, by the time this loan is paid off, they will have paid you $86,335. So up at the top here, line 1, you see that's the amount they owe, 40 grand. Their payment on line 2 is $239.82 per month. This loan is going to pay for 360 months. That's 30 years. At the bottom, where you see the other arrow, that's the total that will be paid to you at the end of the term in 2050. They will have paid you $86,335.20. All right, that's over $46,300 in interest, plus the 40 grand principal balance. So the formula is this. Say you purchase 2 notes similar to the one we just talked about. You buy them at a discount. You pay $2,500 for each one. This is a total cash from you of $5,000, and every month you're going to receive payments from these 2 homeowners. Okay, that's for the next 30 years. So you use those monthly payments to pay your debt. It's that simple. Here's the summary. You owe 110 grand. You buy 2 notes for $5,000. You get that $5,000 back from the homeowners when you reinstate their loan. So that happens within 6 months. The total monthly income from the notes is going to be $479.64 in this particular example. Use that money to pay your debt each month. That's money that you do not have to spend out of your own personal paycheck. Okay? The total income from both of those notes at the end of that 30 years will be $172,670. That's way more than $110 you owe. So this is what you accomplish. You pay off $110,000 in debt with $5 grand of your own money. You get that $5 grand back within 6 months, and you're going to make an additional $62,670 after paying off that debt in full. That additional money goes right into your pocket. It's yours. In reality, the payments from these 2 notes paid off your debt, returned your initial investment, and generated a net profit of over $57,000. Now, there's a process to buying notes. This is the 5-step process. Find the mortgage note, purchase it, work out a solution with the homeowner that they can afford, create the loan modification, have them sign it, and then your return on investment is in the form of your monthly cash flow that's coming in every single month, and that's going to continue to come in. The benefits is that these assets are affordable for the average investor. You're talking $2,500 per asset, $2,000 to $8,000 per asset. It requires approximately 4 to 5 hours per asset, and then it's passive in the long term. So you're going to spend about 5 hours working it, and then after the homeowner starts paying, you put it on automatic pilot. There's no property maintenance, no loans, no fix and flip projects to manage. You don't need any, there's no credit requirements, there's no certifications, no exams, none of that. It creates a long-term continuous cash flow. It's location independent because you're not dealing with property. You do not have to worry about being located in the same area that your note investments are. You are the lender. At this point, the homeowner owes you money. All you do is collect the money. So you make money the same way the major banks make money. Okay, they never visit the property, and neither will you. Notes are highly liquid, and so you can buy a note in 1 or 2 weeks. You can sell a note in 1 or 2 weeks. So your money is not tied up for long periods of time if you need it to cash out. And finally, you get to help people, homeowners that are in distress, that are behind on their second mortgage, and they are at risk of losing their home to foreclosure. You come along, you work with them, work out a payment they can afford, and get them back on track. Now, to find out more about this, I invite you to visit my website at mortgagenoteinvesting.info, where I go into mortgage investing. It's a much deeper dive. It's a lot more detail. It's a 20-minute presentation where you can find out more information. And thank you very much. I hope you've enjoyed this presentation. And please do visit my website. There's also a link on there to my calendar if you have any questions. All right. Thank you very much.